This video is sponsored by Morning Brew. Click the link in the description below to sign up for their daily business newsletter today. Hey everyone, it's Richard. You're watching The Plain Bagel. Breaking news regarding the Canada-US trade war this past week, as we saw President Trump announce that the tariffs he promised to slap on Canada, China, and Mexico on day one of office would finally be taking effect February 1st, this past Saturday, with him declaring that there was nothing these countries could do to stop the tariffs from taking place. Quick update, turns out Saturday was just the executive order. Trump has now announced that Tuesday is definitely the date that these tariffs will be coming into effect, with 25% tariffs being slapped across most goods from Canada and Mexico. What's that? This just in, never mind. Turns out Trump and Trudeau had a phone call and everything's Gucci now. So I guess we're good. That's more or less how this past week has gone for Canada trade relations, with many bracing for an all-out trade war between the two close allies, with Trump announcing the 25% tariff on most Canadian goods and 10% tariffs on Canadian energy, and Canada retaliating with 25% tariffs on a number of American goods that would escalate after a short period of time, only for things to simmer on the announcement from Justin Trudeau of collaborations between the two countries to address fentanyl and illegal border crossings, with Trump postponing the implementation of these tariffs by 30 days, which has led many to wonder, was that all really necessary? After all, Canada and the US have long had one of the deepest alliances and friendships globally, which made these tariffs quite controversial, especially given the reasons provided for slapping these tariffs and how they line up with different data points. But as mentioned, we're not yet out of the woods. The tariffs have been delayed, but it remains unclear what steps are required for tariffs to come off the table here, which has led many to speculate what might actually happen if these tariffs do end up going into place, how devastating they would be for the Canadian economy, and whether the US would see a net positive or negative impact from this protectionist measure. And with the topic being so hotly debated, I figured I'd chime in to discuss what's happened to date, why the tariffs have been so controversial, specifically the ones targeted at Canada, and what we could expect to see happen in both countries. And while many are pushing pretty simplified narratives and at times very bold claims around how tariffs will ultimately impact the US, there are a lot of moving parts when we talk about international trade, so we'll try to cover things in a nuanced manner. Now, to be transparent from the get-go, as a Canadian myself whose largest viewer demographic is actually from the United States, I recognize that sadly, we find ourselves, me and some of my viewers anyway, on either side of the trade frontier, and I'm gonna have a little bit of bias here. I'm a Canuck myself, and dare I say, I wasn't a fan of all this. Trump. That all being said, I'll strive to focus on the data points here, provide sources for the information I share, and try to avoid getting too political here. That's obviously pretty difficult to do given the circumstance, but the goal here is to have a constructive conversation and share information on the topic. So that's what I'll strive to do. So let's start with a quick overview. What exactly went down with the tariffs here? Well, shortly after winning the election in November, we saw President Trump threaten Canada, Mexico, and China with tariffs in the latter half of November on all products entering the country on day one of office. A tariff, of course, is an extra tax that's charged on imports into a country. In the United States, they're paid by the importer, meaning that if you're a US citizen and you import some maple syrup from Canada for $20, you'll find that with a 25% tariff, you're charged an extra $5 for that $20 of syrup. With the idea being that this will incentivize consumers to buy products domestically rather than purchasing products from foreign countries. As for why Trump decided to target Canada, Mexico, and China here with tariffs, according to his own social media posts, drugs and immigrants, with him writing on Truth Social that, quote, "This tariff will remain in effect until such time as drugs, in particular fentanyl, and all illegal aliens stop the invasion of our country." Is that really what they call retweets? Now, since then, Trump has had other complaints about trade between Canada and the United States, with his administration specifically highlighting the auto and dairy industry at times, and more recently, Trump lamenting, mostly incorrectly, that US banks are not allowed to operate in Canada. But most of the time, the complaints have been pretty nondescript, with Trump calling trade between the two countries unfair and lambasting what he calls a $200 billion subsidy that the US gives Canada, with him suggesting the tariffs will go away if Canada addresses fentanyl and immigration into the United States, reduces its trade surplus against the US, or becomes the 51st state.
What I'd like to see, Canada become our 51st state.
Which, to be clear, that's very much still viewed as a joke in Canada, even if that's maybe been forgotten here. Unless you've grown up taking care of house hippos or having nightmares about this guy, quite frankly, respecting Canada's sovereignty is for America's own good. Now, Trump did ultimately delay the tariffs after a phone call with both the Mexican president and the Canadian prime minister, with Mexico promising to send 10,000 troops to the border with the US, and Canada itself making a number of border promises, including putting $1.3 billion towards strengthening the border, hiring a fentanyl czar, listing cartels as terrorists, and launching a Canada-US joint strike force to combat organized crime, fentanyl, and money laundering, with Canada also putting $200 million towards an intelligence directive on organized crime and fentanyl. However, the announcement around the delay has led to the raising of a few eyebrows because the biggest part of this promise of $1.3 billion for strengthening the border is not news. It was announced back in December, shortly after Trump initially threatened tariffs, with even the Joint Strike Force being announced at that time, which gave some the perception that not a whole lot actually changed to pause the trade war. And of course, anything to address the stopping the flow of fentanyl is generally speaking a good thing. But the fact that these tariffs that would ultimately cost economies hundreds of billions of dollars that Trump purported would be a net benefit for the US and could even reduce income taxes, the fact that this was all seemingly put off by such a minor, mostly predetermined commitment has raised questions over what the real intentions with all this are, and has really tarnished the trust and long-term trade relationship between the two countries. Which also leads us into why the tariffs against Canada have been so controversial here, outside the whole annexing a free country thing. Firstly, as has been highlighted many times here, despite being slapped with a similar tariff to Mexico here, Canada makes up a tiny fraction of drugs and illegal migrants that enter the United States. According to the US Customs and Border Protection's own data, the US northern border accounts for less than 199,000, or roughly 6.9% of total migrant encounters, and just 43 pounds, or 0.2%, of the 21.9 thousand pounds of fentanyl that's been seized being smuggled into the country. Which, yes, in both cases is not nothing, but considering Canada and the US have the largest shared land border in the world, it's not bad and clearly not a key contributor to either of the issues. Secondly, there are a number of issues with that $200 billion subsidy claim. For one, Trump seems to be referring to the trade deficit here.
It's not fair that we should have a $200 billion or $250 billion deficit.
Which is not a subsidy. It just means that the US buys more products from Canada than Canada buys from the US, which is a sign of prosperity within the US. As people become wealthier in the country, it's expected that they would buy more products from abroad. Secondly, the number doesn't seem to be accurate. According to the US's own Census Bureau, the US trade deficit with Canada for 2024 was $63 billion. So unless he's counting 4 years worth, that $200 billion really overstates how big the deficit is. Thirdly, the only reason the US has a trade deficit with Canada is because of cheap oil that the country sells to the US effectively at a discount, with the country having one of the lowest priced oil benchmarks globally, even when put up against comparable benchmarks for the type of heavy oil that comes from Canada. And if you strip out this cheap oil, the US actually flips into a trade surplus of roughly $45 billion. Yet Trump was planning to slap a lower tariff on this commodity. Fourthly, Canada's trade balance with the United States is actually one of the smaller among its key trading partners, despite the size or volume of trade between the two. With in fact China, Mexico, Germany, Taiwan, Japan, Korea, Italy, and India all having larger trade surpluses with the United States than Canada. And finally, perhaps the most frustrating point for many Canadians is that the trade deals that Trump is calling unfair here.
I look at some of the deals made, I say, who the hell made these deals are so bad?
Are the deals that he himself set out back in 2019 that he forced Canada and Mexico to adopt after kicking off a similar trade war to replace the long-standing NAFTA agreement, with him at the time calling the current trade agreement that he's now lambasting, quote, the best and most important trade deal ever made by the USA.
Who the hell made these deals?
Now, the US trade deficit has been expanding in recent years, again, under the USMCA agreement, and there are arguments as to why a country might want to limit how much its trade deficit expands. It can lead to a weakened currency as the buying of imports leads to demand for other currencies and less for your domestic currency, which can weaken your dollar, and it can lead to job losses as industries move to other countries where perhaps a given product or service can be provided more effectively or efficiently. But the US doesn't really have an issue on either of those fronts. The US dollar has had a tremendous couple of years, and the job market in America has proven incredibly resilient, with unemployment in the US, while slightly higher than it was a year ago, still sitting at just 4.1%. Now, it's also worth highlighting here that Canada does have a number of its own protectionist measures that have also kind of come up in the debate here, such as dairy, where Canada actually imposes supply management controls of domestic production and imposes quotas on US products beyond which tariffs are charged, and telecommunications, where Canada restricts foreign ownership. With the limitations put in place there aimed to protect the domestic industries from being flooded by its southern neighbor, which has massive economies of scale and would likely overtake any sort of competition. Albeit for banking, Trump's claim of restrictions is mostly incorrect. There are currently US-based bank subsidiaries in Canada. Here's a picture of a Citigroup branch in Toronto. It just hasn't been an overly attractive market to expand into since Canada intensely regulates its banking sector and requires US institutions to set up separate subsidiaries to accept retail deposits in the country, meaning they can't access the parent's company's bank reserves, which is inefficient for them. But even domestically, the protectionist measures around dairy and telecom specifically have been hotly debated over the years, given how these measures, get this, impact Canadian prices. So while it's quite common for smaller countries to try and protect their critical industries with these type of measures, that could be an area where we see the two countries butt heads in the future. The problem there, however, is again, these weren't the reasons provided for the initial set of tariffs that Trump was threatening here. And even if they were, Canada currently has a trade deficit with the US in terms of dairy, and the US also imposes ownership restrictions on telecommunication companies operating in the US because, get this, they want to protect their infrastructure. So while the arguments there do get messier, it shows why many don't believe this situation warranted such a massive escalation of the trade relationship, which has led many to believe that given these tariffs were delayed a day before they went into effect, that this has all been a bargaining tactic, especially given that the USMCA trade agreement comes up for renegotiation in 2026. And given what's felt like moving goalposts here, there remains a lot of anxiety over what will ultimately be required to end this trade war once and for all. Which brings us to the next topic. What could we actually expect to happen in Canada and the US if these tariffs did in fact go into effect? The difficult thing with trying to forecast how tariffs that haven't yet been put in place will ultimately impact the two countries and their economies is that there are a lot of moving parts, and it's hard to forecast accurately how different companies and consumers will adapt or change their behaviors based on the higher tax. You also have to consider retaliatory tariffs, with Canada again threatening its own on US goods, and Trump suggesting that he would escalate things further if that were to happen. But most experts would probably agree that certainly, at least in the short term, it'd be pretty negative for both countries, certainly Canada, but even for US consumers. At a very high level, tariffs are considered to contribute to inflation, given that they reduce competition. The domestic producers no longer have to price compete with foreign producers. That can lead to higher prices and lower options for consumers, especially in cases where they don't have as many easily accessible substitutes available. And it can benefit producers and lead to more jobs, but generally comes at the cost of consumers. It can also lead to a less efficient use of capital as countries invest in areas that they might not have an economic advantage in versus just buying cheaper products from abroad. And certainly this type of volatile situation can discourage investment in different industries and certainly foreign investment, given that investors aren't going to want to put more money into companies that rely on imports that face this on again, off again risk of tariffs or trade war escalations. Now again, this can lead to more jobs in the industries that the country imposes tariffs for, meaning that in this case, we might see the US add more resource focused or industrial positions, but in the short term, there's likely to be a lot of friction, and we could actually see unemployment increase as forecasted by S&P Global, which sees US unemployment rising 0.2 percentage points in 2025, as companies that currently rely on integrated supply chains become less profitable, albeit this does also factor in retaliatory tariffs. This is even an issue for areas where the country might already be producing enough of a given commodity to meet its domestic demand, such as with crude oil, where the US does produce more than it needs, but doesn't really have the pipelines and infrastructure to service itself, with the supply chain between Canada and the US being heavily integrated, and much of America's refining capacity being geared towards a type of heavy crude oil that Canada produces versus the light oil that it produces domestically, meaning that even if the oil is there, the country might not have the capacity to actually refine it to the end products that it would need to use. So it would likely take quite a while for the country to become self-sufficient in some of these industries as it tries to invest in the necessary infrastructure to onshore these types of trade and operations. And even if the country gets to a point where it is able to onshore its operations and maintains these protectionist measures, it could lead to a permanent increase in price levels, just given regulatory, labor cost, or economics of scale advantages that might allow other countries to produce those things better or more cheaply, which has always been kind of the argument for free global trade, that countries can specialize in different areas and see mutually beneficial trade from their focused efforts rather than trying to each become a jack of all trades. So at a high level, again, in the short term, there would likely be a lot of friction. But that's all at a high level. What actual figures can we expect here? Well, again, as mentioned, it's very difficult to forecast here, but we do have a number of estimates from various institutions, with the Peterson Institute for International Economics estimating that the Canada and Mexico tariffs together could reduce GDP in the United States by 0.2 percentage points in 2026 without retaliation, and 0.5 percentage points with retaliation, which compared to 2023 GDP figures equates to very roughly $136 billion. In terms of prices, it's estimated to bump inflation up by 0.4 percentage points without and 0.9 percentage points with retaliation. And in regards to unemployment, when factoring in as well the Chinese tariffs, S&P Global estimates that unemployment could tick up 0.2 percentage points in 2025. As for why we could expect a broad-based impact, that just has to do with the nature of the trade between Canada and the US. Canada is the US's second largest trade partner and primarily provides raw materials that are used widely as inputs for a number of industries within the US, with energy obviously being one of the most visible examples. Roughly 52% of the US's oil imports came from Canada in 2023, or roughly a quarter of their total oil consumption. And outside of directly increasing the cost of fuel, with TD Bank estimating that tariffs could increase US gasoline prices by as much as 30 cents to 70 cents per gallon, it would likewise increase the cost of anything that either needs to be transported or uses some sort of oil derivative as an input. Another area that would see a very visible impact is the automotive sector, where Canada, Mexico, and the US have very integrated supply chains. And despite Canada only producing roughly 10% of American cars, or roughly 1.5 million units, because even US manufacturers often source parts from either country, a given car can cross the border up to 8 times before it's finally produced. With TD again arguing that the average US retail car price could rise by roughly $3,000 as a result of these tariffs, depending on retaliation. And there are a number of other inputs and commodities that Canada is a key supplier to the United States for. Canada supplies 50 to 80% of US zinc, tellurium, nickel, and vanadium needs, 27% of America's uranium imports, roughly 40% of America's lumber imports, with the country being a net importer in that industry, over 80% of the country's potash imports, which is an important component for fertilizers, and something the US does not really produce domestically, importing 90% of its consumption needs. And even, as you might not be aware, electricity, with Canada directly supplying hydro-powered electricity to mostly northern states, but even some further south like California and Arizona. So from a strictly economic standpoint, tariffs are likely to have a negative impact on economic activity. Yes, there are circumstances where foreign suppliers might choose to lower prices to try and offset some of the lost demand from higher tariffs, which lead to ultimately higher prices. But given the commodities that are being traded here, there's not much of a profit margin to eat into for these companies to offset that tax. So ultimately, consumers are going to be bearing the brunt of these higher costs. So again, in the short term, it's very likely that we see that price impact. And while Trump has floated this idea that tariffs could offset income taxes in the country or even completely replace them, as highlighted by the Peterson Institute for Economics, that would more or less be impossible. In 2024, the country raised nearly $3 trillion in personal and corporate income taxes and imported $4.1 trillion of goods and services, meaning they need to charge tariffs of 73% on all imports and would need to maintain that current level of imports despite them now costing 73% more. So while having tariffs pay for your income taxes sounds great on paper, it's not really feasible, and consumers are still likely to bear the cost of higher prices. That all being said, let's of course be clear here. The impact is going to be much more severe on Canada, given the country's dependence on the US. Canada sells 77%, or 3/4 of its exports, directly to the United States, versus 18% of US exports that go to Canada. And the Bank of Canada recently released a publication arguing that Canada could see its GDP growth fall 2.5 percentage points as a result of tariffs in year one, which compared to 2023 GDP, again, translates roughly into $53.5 billion. And in year three, it could expect that inflation would be a full percentage point higher. Meanwhile, S&P Global estimates that unemployment in Canada would jump 0.6 percentage points in 2025 if you factor in retaliatory tariffs. Energy specifically would be heavily impacted, with 97% of Canada's oil exports being to the United States, which actually explains why the country sells its oil at a discount. And likewise, there would be a need to build up more infrastructure to sell to other markets or even to service the country domestically. Now, the good news here is that even if the country does enter a trade war, it does not spell the end of Canada. The country has actually dealt with high tariffs with the US in the past, having higher tariffs well above 25% all the way up into the late 1940s. And exports to the United States represent roughly 20% of the country's GDP. So we might see a sharp recession if we see a severe impact on that activity. There is still domestic demand and trade with other partners for different industries. Also, given what we've seen to date, most analysts don't expect tariffs to be implemented for a long period of time. However, it doesn't take long to cause meaningful damage. Back in 2018, when Trump kicked off his first trade war with Canada and, at the time, Mexico, specifically around steel and aluminum, we saw a 25% tariff implemented on steel products from Canada from June to May of the following year, which led to a 37.8% year-over-year decline in the first month of the tariffs being active, and brought steel exports to a near-decade low by the time the tariffs were lifted. And that was just with one industry. So while a trade war would not end Canada's economy, Additionally, a broad 25% tariff on most goods from the country, and even just a 10% tariff on Canada's energy could contribute to a sharp recession. It would likely take years for Canada to recover from if kept in place for a long enough time. But that's the situation we find ourselves in, and we'll have to wait and see how things develop from here. If we see further collaboration and a mutually beneficial outcome, or if we see an escalation of rhetoric and the tactics being used here. And to my US viewers, again, I know I'm going to have my own Canadian bias here, but hopefully this was a constructive conversation and, again, brought more information to the table. And while I'm not one for confrontations and threats, just know, we do have this guy in reserve. Don't make me unleash this guy. He's allegedly over 7 feet tall and 400 pounds. So let's resolve this in a cordial manner and keep this guy at home. Anyway, that's the video. Thanks for watching. And before I sign off, I do want to give a quick thank you to today's sponsor, Morning Brew. If you find that you're learning about all these updates for the first time and you'd like to learn about these things as they're happening on a daily basis, I highly recommend you check out their free newsletter. They send out a newsletter 7 days a week summarizing the important happenings around the world, in addition to business, finance, economics, and a lot of other important stuff. For example, you can learn about how China has responded to Trump's 10% tariffs, which have actually come into effect as of this week, with them now implementing retaliatory tariffs, and learn like I did about the other actions being taken by the Chinese government here, such as tightening export controls on minerals, investigating Google on anti-monopoly practices, and devastatingly, restricting operations of the company behind Tommy Hilfiger. And they're genuinely a really enjoyable read. The writing is witty, funny, and entertaining, and it covers a lot of ground. And the best part, as mentioned, is they're completely free. So if you'd like to start reading about the daily happenings, you can click the link in the description down below to sign up. It takes just a few seconds to enter your information, at which point you can start receiving their daily newsletter. So thank you, Morning Brew, for sponsoring this video. Thanks for watching. If you like this video, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts down below, whether you agree or disagree, whether you're Canadian, American. Very much encourage constructive conversation on this. I'll see you in the next one. And as always, be safe out there.